Thank you very much, Fabian, and hello, everyone. Thank you for being here. I have about 15 minutes, and I want to do 3 things in those 15 minutes. If I could get my slides up, I'll show you. One, I want to talk about the 3 characteristics of transformative technologies. I know that these 2 days have been filled with sessions that talk about how transformative digital technologies are for finance, and I want to put together a framework and share it with you and see if you would agree that we're not quite there yet, but we will be, thanks to the genius of people in this room and beyond. And then I want to do what the majority of my remarks are what Fabian referenced, which is what are the credit implications of this digital transformation, not just the technology, but the transformation of behaviors, products, services, and regulation, and then how we're preparing for it. And much of our preparation, of course, depends on Fabian and his team and the work they've been doing. So I'll echo some of what he said. So the 3 qualities of a transformative technology. I know you've been talking about the internet, so I decided to use a different example to bring these to alive. I'm going to use the internal combustion engine. So the internal combustion engine, first invented apparently in the 10th century or so, didn't get very far. It was only in the 19th century, especially the second half of the 19th century, that the technology became really, really good in the way that digital is now, or the way that the internet was 50 years ago. It started becoming really, really good, but it was not transformative. Like, the technology was fascinating. If you were a scientist, you were amazed at how far propulsion could, sort of move things, but it wasn't really transformative. It was only in the early 20th century that it became transformative. Why? Because of, sort of reason number 1. You had a use case in automobiles that served consumers, so anybody could drive a car, and it could serve them. It served workers and producers because you could create factories where workers could create these things at scale easily. You didn't need to be super skilled. You need to have some skills, and you could do this. And it motivated investors because you could actually make a profit investing in these things and selling them at a price that the mass market would buy them. So that was number 1. You need the technology to have a use case, not just for consumers, not just for business, but for all 3 segments. And that, I think, is where digital technology is going. There are use cases for consumers, there's use cases for business, there's, of course, use cases for workers producing them, all of you, but not at scale yet, but I think we're getting there. Number 2, you need the technology to really transform. So it's more than a car. You need it to provide use cases to other segments of the economy and society. So if you think about the automobile, yes, of course, the steel industry benefited, aluminum benefited, gasoline benefited, but the creation of highways. You had highways being funded and built. You had commerce alongside the highways, petrol stations, things like that. Because you had highways being built, you could build suburbs that created their own microeconomies. Because you had highways, you could fund them with project finance, so created financial products. You could securitize the toll revenues that you got from them, another innovative financial product. You could make auto loans to people who can't afford to buy a car in full, but are happy to pay the loan in segments. You could securitize that, and you had auto ABS being created. Again, innovative finance being created. So you got a lot of different economies being generated just by the fact that people were now moving further, faster to new locations. And the auto industry is still generating use cases. My favorite one, by the way, is when 2 brothers, the Michelin brothers, decided to provide a free booklet to everybody who had a car to tell them where they could take that car and sort of buy things or go to restaurants and things like that. It was a free booklet just so that their tires would go further and they could generate more and more production. Of course, that Michelin booklet has now led to the Michelin stars. It's no longer free, by the way. You have to pay to sort of know who's on the Michelin star. And if I wanted to do another job other than credit ratings, rating restaurants would be it. So think about that the next time you're having your $100 amuse-bouche at a 3-star Michelin restaurant. Combustion engine. Without it, that would not be possible. So that's number 2. But also think about sort of society. Thelma and Louise, the movie, would not be as much fun without the car. Number 2. Number 3, imagine these people driving around everywhere in a vehicle that can kill without traffic lights, without driver's licenses, without the requirement of having insurance, without speed limits. The first speed infraction, by the way, was in this very city in New York. The guy was going at 12 miles an hour. The speed limit was 8. They threw him in jail because the regulatory framework hadn't evolved enough. It was in 1899. The regulatory framework had not evolved enough to say, if you're just going at 12 miles an hour, you don't have to go to jail. We can just write you a ticket. You can pay a fine and let go. But the regulatory framework evolved. And I would argue that you wouldn't have an automobile economy without that regulatory framework. And to the person who was in the elevator with me this morning as we were climbing up here, who was talking about the work they do on KYC and AML, they were saying, well, this is not the most exciting part of blockchain technology. I would say to you, the technology will not move forward without your work. That legal, regulatory, safety framework is really important. So those are the 3 things that I think are very, very important before the technology becomes transformative. Now, I don't know if I clicked right. I'm trying to go to my next slide. There we go. How are we thinking about, so the technology that I just talked about basically made people move further, faster, but they changed how people live their lives, and that's what created the new business models and the new business processes. Similarly with digital technology, it enables the transfer of both liquid and illiquid assets further, faster in new areas. And that's what's going to be transformative. And what it's going to do is change the way people and institutions spend money, save money, invest money, borrow money, lend money. It's going to change all of these things over the coming decade. And what that will do, and that this is coming back to Fabian's point, is that it will either raise risks for some entities that we rate, it might lower risk for some entities that we rate, it might transfer risk from a lender to a borrower to a lender, or either which way. It might reallocate risks in a stack of lenders or borrowers. So those are the kinds of things we're thinking about, that, okay, this technology, lots of use cases, lots of, safety measures, mitigants being provided, but how will it really change how finance works, and what are the risks being created? How are we preparing for it? We've divided our preparation into 2 parts. And I'll only speak to the analytical, because I know I have colleagues here who are doing a lot of work on the business side, and analytical is my domain. In the analytical sphere, the first thing we did is, yes, this is a big, beautiful, to quote sort of a very different thing, this is a big, beautiful technology. But you need to untangle how it comes into the financial framework and the different risks that coming in poses. So we've untangled it into 3 parts. One is the infrastructure. And the question that we're asking is, okay, we have a rated universe. Is digital infrastructure, is a DLT bond, exactly to Fabian's point, adding risks or sort of reducing risk when it is issued to the public? And as Fabian said, most of the DLT bonds that have been issued and that we have rated have had some mitigants, like actually twinning off-chain, that have allowed us to say, look, the credit risk is the same because the issuer is taking on the credit risk, not the lender to it. So that's one, digital infrastructure. The second is native digital assets. And here we have sort of a 2-fold view. One is when those, like stablecoins, are structured as fixed income instruments, can our existing methodologies be applied to tell you, the market, how risky they are? Is it a AAA or a BBB or what have you? And we're looking at that very closely. Some are indeed structured in ways that our existing methodologies allow us to rate. Some are not, and we're looking into how we need to evolve our methodology so that we can do our job, which is to tell the market how risky a particular instrument is. But we're also looking at it, okay, the holders of these assets. So when, for instance, either a bank or a pension fund or other entity decides, or actually a corporation, and many tech corporations do this, that we're gonna, our liquidity portfolio, the liquid portfolio, we're gonna put a little bit of that into crypto. Our analysts say, well, if it's less than 5% and you're a highly liquid company, absolutely no credit risk added. But if it's more than 20%, cryptocurrencies are still a very volatile product. So your liquidity is, could go up and down with that volatility. That would be a credit risk. We would see you as not having access to liquidity if your portfolio is invested in a very volatile products. So that's some of the ways that we're looking at it. CBDCs, again, we look at it, does it help monetary policy transmission? What macro implications does it have? Does it ease cross-border payments, et cetera? And then in terms of digital exposure, and I'll go into both the infrastructure and exposure a little bit more, fascinating how it's going to change business models in finance particularly, but even beyond, in the tech world, in the manufacturing world, especially as you think about how this can be applied. So the way we've gone about it is about 10 years ago, we started doing research when all of this stuff was a twinkle in people's eyes. We started looking at blockchain. We started looking, at the time, fintech was sort of a new shiny thing. Started looking at all of that. And we've been doing all this work over 10, not because we thought tomorrow the world's going to change and we're all going to be issuing debt on the blockchain, but we thought we need to start doing the research now so that if in 10 or 20 years the time comes, we are really prepared. And I'm really proud to say, I hope you get to read some of our research. It gets more and more sophisticated the more we do. And the ones that I flashed on the screen, I noticed it once we prepared the slide, that a lot of them says, this is raising risk, so this is, and that's our job. We've got to be really neutral in saying, yes, this is a fantastic technology and it's being applied to a fantastic instrument, but actually, these are the 3 risks that it's raising. And then somebody will find ways to either say, I'm going to mitigate those risks, or I'm happy taking those risks because I'm being paid to take those risks. That's not our job, but our job is to point out where the risks are. So research is the first step in preparedness. The second step in our preparedness, and this is something that Fabian already alluded to, so I won't go too far into it, but just to say that when we think of the infrastructure, digital infrastructure, we think of it as part of operational risk. And generally, in most cases in the credit analytic world, operational risk, if you have strong governance, and if you have a long track record, you'll have operational risk, but they won't translate to credit risk. In this case, it's a new technology, so hard to have a long track record. So we do look at whether the technology itself poses operational risk. And the 4 blocks that you saw on that slide were the same ones that Fabian referenced. This is what we look at when we want to see whether the risk is being added via platform risk. Is it asset representation risk? Is it cyber risk, that there's not enough mitigants for cyber risk? And then, of course, smart contract risk. And then the last slide that I'll leave you with, and I do keep this on for a while because it is just so difficult to look at, like every good piece of art should be. And this slide, I like to put it up because it tells you that at Moody's, we've got a bunch of really deep thinkers who are very quantitative. They model risks all the time, and they've been part of making this slide. We've also got poets who help us tell these complex, very nuanced stories in ways that actually make sense to people who are not deep into the modeling world. And then, clearly, we've got artists who have translated all of this into a visual. Not going to go into it, but I think this speaks to the business model risk that digital technologies pose. And it could be, by the way, upside as well as downside risk. So it's not all doom and gloom. And what we thought is, look, you have technologies, and we've put up digital, AI, others. We want to think about the channels. The channels will come either through something that generates revenue, like new products or services, or something that affects your costs or your need for borrowing and investment, or sort of external risks like cyber, things that challenge your governance. So those are the channels of risk, and that's that sort of second beautiful arc there. And then, ultimately, we want to translate this into what we care about, which is our methodologies, and we want to translate it into credit metrics. Is it going to raise debt to EBITDA? If debt's rising, but your EBITDA, your profits are rising as well, probably ending up neutral. But if one is rising and the other is not, it could be positive or negative, things like that. So this is how we're going about taking something that is going to be transformative, not yet, but will change how particular issuers' ratings are. I mean, somebody that's a double B today might be a triple B or a single A, or the other way around. And that, that direction of travel will actually be determined by the people in this room. The products that you create, the risks that you mitigate, the way that you transform the world. And one thing that I didn't put up in my sort of 3-notch, what makes a transformative technology, is smart people coming together, challenging each other, giving each other good ideas, And that, I think, is the point of this meeting today. So thank you for that. Thank you for coming together, challenging each other, and giving each other ideas. And with that, I'm going to hand over to Insha.